In 1989, Japan controlled nearly half of the world's stock market value. At one point, the land beneath the Imperial Palace in Tokyo was believed to be worth more than the entire state of California. The world didn't just admire Japan, it feared it. This was a nation that had risen from the ashes of war to become an unstoppable economic force. But fast forward to today, and the same powerhouse finds itself trapped in slow growth, weak innovation, and an aging population. So, what really happened? Did Japan simply slow down, or did the system that once made it great quietly break from within? To understand this, you have to go back to the foundation of Japan's economic miracle. This wasn't luck, it was one of the most precisely engineered economic systems in modern history. At its core was the Keiretsu network, a tightly interconnected web of banks, manufacturers, suppliers, and trading companies, all linked through cross-shareholding. This structure eliminated internal competition and created a system where companies operated with long-term vision instead of short-term pressure. There was no fear of hostile takeovers, no obsession with quarterly profits, only a collective drive toward dominance. Alongside this corporate structure stood a powerful guiding force, Japan's Ministry of International Trade and Industry. This institution didn't just regulate industries, it actively shaped them. It directed capital, identified winning sectors, and ensured that Japan's industrial machine operated with precision. Then came the workforce model that reinforced it all: lifetime employment. Employees didn't just work for companies, they became part of them. Loyalty, discipline, and deep specialization defined the Japanese worker. The system didn't prioritize speed, it prioritized perfection. And in an era dominated by manufacturing, that was more than enough to lead the world. But every system has a breaking point, and for Japan, that moment came in the late 1980s. Easy credit flooded the economy, creating one of the largest asset bubbles in history. Stock markets soared, real estate prices became irrational, and companies shifted their focus from productivity to speculation. The illusion of endless growth took over. Then in 1991, the bubble burst. Markets collapsed. Asset values plummeted, and balance sheets were left in ruins. It was a critical moment, a chance to reset, restructure, and rebuild. But Japan chose a different path. Instead of allowing failure, it protected the system. Banks refused to write off bad loans. Corporations avoided restructuring. The government stepped in to prevent major collapses. Stability was prioritized over transformation. And in doing so, Japan unintentionally created a deeper problem: capital misallocation. Money continued flowing into inefficient companies, outdated industries, and non-competitive structures. The economy didn't crash, but it stopped moving forward. This period would later be known as the lost decades. Out of this environment emerged one of the most damaging phenomena in modern economics: zombie companies. These were businesses that should have failed, but were kept alive through cheap credit and institutional protection. They didn't innovate, they didn't grow, they simply existed, and in doing so, they consumed resources that could have gone to new, more dynamic companies. They blocked competition, slowed productivity, and gradually choked the energy out of the entire economic system. At the same time, the global economy was undergoing a transformation. The world was shifting from manufacturing to digital, from hardware to software, from efficiency to agility. Innovation was no longer about perfecting existing systems. It was about disrupting them. But Japan's structure wasn't built for disruption, it was built for stability. Corporate hierarchies were rigid, decision making was slow and consensus driven. Failure was not tolerated, it was avoided at all costs. This created a massive disconnect. While Silicon Valley embraced risk, experimentation, and speed, and while China scaled digital ecosystems at an unprecedented pace, Japan remained anchored in its traditional approach. Even iconic companies struggled to adapt. The issue wasn't capability, it was structure. The system that once created excellence had now become a barrier to evolution. And beneath all of this lay an even deeper challenge: culture. Japan's corporate identity is rooted in harmony, collective thinking, and respect for hierarchy. These values are incredibly powerful in stable environments, and in times of rapid change, they can slow down decision making. Innovation often requires disagreement, friction, and bold moves, but a system designed to avoid conflict naturally resists disruption. Over time, this cultural strength became an innovation constant. Then came the most unavoidable challenge of all: demographics. Japan is one of the fastest aging societies in the world. The workforce is shrinking. While the number of retirees continues to grow, this creates a dual pressure: lower productivity and higher social costs. But the impact goes even deeper. Younger populations tend to spend and drive consumption, while older populations tend to save. As Japan aged, domestic demand began to weaken. Economic momentum slowed further, not because of policy failure, but because of population reality. At the same time, Japan's economic policies created another layer of complexity. To support exports and maintain growth, interest rates were kept extremely low for prolonged periods. This led to a weaker currency and an over-reliance on cheap money. While it provided short-term stability, it limited long-term flexibility. Japan found itself in a position where many of its economic levers were no longer as effective as before. But now, in 2026, a shift is underway. Japan is beginning to recognize that incremental change is no longer enough. Structural reform is no longer optional. It is necessary. The country is slowing dismantling traditional corporate structures, encouraging startup ecosystems, and improving corporate governance. Venture capital is being promoted, entrepreneurship is being redefined, and perhaps most significantly, Japan is opening itself to immigration, a major cultural shift for a historically closed society. At the same time, the country is doubling down on technology. Automation, robotics, and artificial intelligence are being deployed to counter the shrinking workforce. Smart factories, digital infrastructure, and AI-driven systems are becoming central to Japan's next phase of growth. The strategy is clear: if human capital is declining, technological capital must rise. But the question remains: is this transformation happening fast enough? Because in today's world, speed matters more than ever. The global economy is no longer forgiving. It rewards those who adapt quickly and penalizes those who hesitate. Japan's story is not just about one country, it is a global lesson. Many developed economies today face similar challenges: aging populations, rigid institutions, and slowing innovation. Japan is simply ahead in the timeline. It is a preview of what happens when success creates systems, and those systems are not challenged. Because ultimately, the greatest risk to any system is not failure, it is rigidity. Japan didn't collapse, it slowed down. And in a world that is accelerating every day, slowing down can feel exactly like falling behind. If you want to stay ahead in a world that is constantly evolving, you need the right systems and the right guidance. For education, career clarity, and global opportunities, you can connect with Vidya Infinity at vidyainfinity.com. And if you are looking to build or scale your business with complete support from government approvals and financial services to digital marketing, branding, and technology solutions, you can work with Infinity Growth Tech at infinitygrowthtech.com. thegrowthtech.com. Everything your business needs under one roof. This is not just a story about Japan. It is a reminder. Adaptation is no longer optional. It is survival, and those who understand this early will lead the future.